Market sentiment has improved recently, and stocks have recovered since bottoming in October of last year. Sentiment has been helped by increased clarity surrounding Fed policy, and in particular, the likely terminal Fed funds rate, while moderating inflation and the potential for a soft landing for the economy have all helped markets. After a historically challenging year for the bond market, bond yields have stabilized recently, and bond market volatility has reduced, helping to underpin recent asset class strength. We have been pleased with the performance of alternative income-oriented strategies, which have performed well despite the challenges facing broad public markets, helping shelter our clients' portfolios from the broad-based volatility. There is a push and pull underway with respect to the economy. Diverging economic data point on the one hand to a soft landing, or lately talk of a no landing scenario, with recent positive economic surprises driven by continued strength in the labour market, which in turn supports ongoing consumer spending. On the other hand, leading economic indicators such as manufacturing and housing point to a contraction in economic activity. While the risks of a recession are elevated, if one were to occur, we believe it would be relatively mild, and particularly mild in comparison to the two most recent recessions, as the economy simply doesn't have anywhere near the level of excesses built up as it did in the years leading into 2008. We anticipate inflation to fall over time, but to remain elevated and sticky over the near term. This backdrop, combined with an increased chance of a soft landing, will likely dictate Fed policy. And on this point, we believe a structural shift is underway. Whereas the years post-2008 were marked by easy monetary policies, that is, low interest rates and quantitative easing, we expect the forthcoming period to be marked by tighter policies, such as higher interest rates and quantitative tightening. We are constructive on the outlook for stocks and bonds from current levels. Longer term, and with a backdrop of tighter monetary policies, we expect a moderation in stock market returns over the next decade, relative to the strength experienced in the post-2008 years ending 2021. This isn't to say we're bearish on the outlook for stocks. We're not. We just think expectations need to be reset for returns more in line with historic averages of mid to high single digits. Bond yields have stabilized and are more attractive today, particularly at the short end of the yield curve, where we are finding some attractive risk-adjusted return potential. Going forward, we believe select income strategies are well positioned to generate enhanced risk-adjusted returns and yields with limited correlation to the broad stock market. We continue to focus on long-term fundamentals and believe our portfolios are well positioned to continue to meet the long-term goals of our clients.